Welcome to the ACA conference in New York City. I'm Jane King. With me is Larry Antonatos of Brookfield, and we're going to talk about real estate and infrastructure here today. So let's should we divide those up, or do you think, what are the similarities, would you say, in terms of investing in those two sectors?
So real estate and infrastructure both provide similar investment benefits. They're designed to provide a mix of income, capital appreciation, and inflation protection when you need it.
Okay.
So very similar investment benefits. Real estate, I think, is very widely understood. Shopping malls, office buildings, apartments, industrial. Infrastructure is less well understood. So let me just define that. That's typically, we break it into utilities. That can be electric, water, gas utilities. Energy infrastructure, like oil and gas pipelines. Communications infrastructure, such as cell phone towers. And transportation, airports, seaports, toll roads. So those are the big areas of infrastructure investing.
And what are people looking for when they're looking at infrastructure investing?
So infrastructure and real estate both provide those similar investment benefits, but the way that these two asset classes differ is just the fundamental business model. Real estate is a free market business governed, like everything else or almost everything else you can invest in, by the laws of supply, demand, and pricing. So supply is essentially unconstrained. There are many property developers and they can build new buildings whenever they want to. Demand for real estate tends to move with economic activity. More economic activity, more demand for space, more household formation, more demand for apartments, more goods moving through industrial buildings, et cetera. And then pricing is simply where the line of supply and demand intersect, and that creates the rental rate or the price. So it's a free market business. Infrastructure, in contrast, is a regulated business. So the supply of infrastructure assets is actually regulated or limited by the government. Most cities, there's only one airport. Most places you live, you have exactly one choice for a water utility or a gas utility. So that creates some stability from a supply side. From the demand perspective, demand for infrastructure services tends to be very steady because they are the essential services. They are the backbone of the economy. So think about what we do every morning. We wake up, we turn on the lights, that's utilities. We check our iPhone first thing in the morning and then 100 times a day, that's communications infrastructure. Brush our teeth, take a shower, that's another utility. And we may drive on a toll road, fly through an airport, and we may buy something online that is moving through some sort of distribution network. So there's all kinds of stability, not only when the supply of infrastructure, but the demand. And then you think about pricing, infrastructure services tend to be priced on a regulated basis by the government. So even though real estate and infrastructure provide the same investment benefits, real estate is higher volatility, infrastructure is lower volatility.
The government wants to make sure that we can have affordable things that we need, water and electricity and things like that.
And I think about infrastructure as a three-legged stool. All the participants have to be reasonably happy. That is, the investor who is providing the service needs to earn a good return. The consumer needs to get a good product, and the government wants to make sure the prices are not too high
so they can keep being elected.
So they can keep being elected, exactly.
Got it. In terms of maturity of the markets, I mean, how do investors see those? Real estate is something that's mature?
Yeah, I would say that most individual investors have real estate in their portfolio or have had real estate in their portfolio over the course of their investment life. The same is also true for institutional investors, insurance companies, pension funds, endowments. Real estate has long been a part of many, many portfolios. It's widely held, it's widely understood. Infrastructure tends to be thought of as a newer asset class, and it's also less widely held, less understood. And I think investors should focus on infrastructure as a complement to real estate. As I said earlier, they provide similar investment benefits with different business models, different volatilities. So having both real estate and infrastructure in your portfolio creates diversification benefits.
You need good infrastructure to have a good real estate market, I would think.
Absolutely.
So thank you so much, Larry. Very interesting.